The positive market trends that began in January of this year continued into the second quarter, allowing the S&P 500 to reach new all-time highs. The current economic expansion that was born out of the financial crisis is officially now the longest on record. What has been driving the equity market higher in the last 6 months? One of the biggest factors is the dramatic change in the Federal Reserve Board's interest rate outlook. After announcing 4 increases to its benchmark target rate in 2018, many anticipated a pause in the Fed's interest rate hike program. However, recent economic data has indicated plateauing wage growth and anemic inflation. The anticipation of a Fed pause has morphed into an outright expectation of interest rate cuts. The market is now expecting that the Federal Reserve will cut interest rates several times this year in an effort to prevent further slowing. Even with the S&P 500 up about 20% this year, stocks are not overvalued. The current price-to-earnings valuation of just over 17 times forward earnings is right in line with its 25-year average. Nevertheless, we don't believe that we will see further expansion of the price-to-earnings multiple this year. The margin boost from the tax cut last year has played out, and most companies expect a pause in earnings growth in 2019. For these reasons, we think returns on stocks will be driven by dividends and buybacks, and we continue to look to invest in companies that are focused on returning value to shareholders this way. Alongside the Fed's pivot toward rate cuts, the 10-year Treasury yield has fallen precipitously from over 3% last fall to 2% at the end of June. In fact, the entire yield curve has dropped, and the 2-year Treasury no longer offers a yield that is higher than the S&P's dividend yield, as it had for the past year. Despite the record-length economic expansion, we see no signs of imminent collapse at this point. We remain fully invested and focused on our pivot toward more defensive, value-oriented stocks that offer dividend income as opposed to growth companies that are more dependent on capital gains.